The US stock market has just made its most rapid 10% jump since May of 2025. Following what appears to be a failed ceasefire of the war in Iran. In fact, we've only seen the market jump by 10% this quickly 4 other times since 2009. In April of 2020, in January of 2019, in October of 2011, and in March of 2009. Each and every single one of these rallies was followed by considerably more upside on the stock market in the months that followed. Meanwhile, we just got the latest data point for the Consumer Confidence Survey from the University of Michigan, and it's not a pretty sight. This is a survey that tells us how people feel about the future of their own financial situation and the economy, and it's currently hovering at weaker levels than at the heart of the great financial crisis. So the war in Iran is certainly not making everyday people more optimistic about the economy, unlike what investors seem to be pricing into the stock market today. And so to many people, this rapid price increase on the US stock market feels fake. It feels like a last hurrah that's really just waiting to unwind and catch down to reality. That is certainly the opinion that many news headlines are portraying right now. Now, at the onset of the war in Iran, the stock market did drop. They corrected by roughly 10% as oil prices spiked. The reason for this is very simple. There were real, legitimate concerns about the possibility of an economic recession taking place as a result of the oil shock. Now, there's been attempts to reopen the strait and have a ceasefire in the Middle East, which has made oil prices stop rising and has seemingly cleared up all concerns around the possibility of a recession taking place. So the real question we should be asking is whether the developments that we've seen so far are enough to completely eliminate the possibility of a recession happening in the next year. If so, then the stock market rally may be durable after all, and if not, this is indeed likely a last hurrah. The most important characteristic of a recession, according to the NBER's own definition, is by far rising unemployment. Indeed, in every single recession that's been documented over the last 50 years, we saw the unemployment rate rise considerably. And when we look at what's been happening to the unemployment rate over the last couple of years, we see it has also been rising. Now, not enough to be classified as an actual recession, but enough to tell us that the economy has been weakening, and clearly enough to get ordinary people very pessimistic about the future of the economy. Now, the worst part is that this was happening before the onset of the war in Iran, before the oil shock. And at a surface level, this is a pretty concerning setup because throughout history, large jumps in the price of oil have often been followed by a rise in the unemployment rate. This was certainly the case in 2008, in 2001, in 1990, and in the 1970s and 80s. But what is astonishing about what's happening today is we are 2 full months following the start of the war in Iran, and we've actually seen the unemployment rate begin to turn back down. So in other words, the job market is not weakened following the oil shock. If anything, it has strengthened. And it's not just the unemployment rate, we're also seeing this in other job market data like initial jobless claims, which records how many people are filing for unemployment benefits every week, and over the last couple of months, they've been making new lows despite the jump in oil. Now, you might be wondering, why on earth is this happening? And this actually reminds us that oil is not the only macroeconomic variable that we should be paying attention to. Yes, oil is a massive factor to consider, especially when it sees outsized swings in its price, but there is another key factor to be paying attention to, and that is the Federal Reserve. This is the most powerful financial institution in the world that controls the supply of the world's reserve currency. It's only by weighing these two incredibly important factors against one another that we can get an accurate picture of the probability of a recession taking place in the coming months. The Federal Reserve has been cutting its interest rate over the last year and a half at a very steady pace in an effort to stimulate the economy in response to the weakness that we've had on the job market and the low consumer confidence that we discussed earlier. Most academic research suggests that there is roughly a year and a half lag between the moment that the Federal Reserve lowers its interest rate and the moment that it actually has an impact on the economy. And we can see this very clearly by overlaying the unemployment rate and shifting forward the Federal Reserve's interest rate by a year and a half. We see generally when the Federal Reserve is cutting interest rates in the year and a half that follows, the unemployment rate is falling. And we see generally when they're raising interest rate in the year and a half that follows, the unemployment rate is rising. So this gives us a general blueprint for what to expect from the unemployment rate in the next year and a half. And so here we're starting to get a picture for why the unemployment rate has actually been rolling over recently. We are entering the sweet spot where the Federal Reserve's interest rate cuts from the last 2 years are starting to take effect. So even if the Federal Reserve pauses interest rates today, the reality is that this trend of a stronger job market could continue as long as we don't have a major shock to the economy. So coming back to the two fundamental forces that we are weighing in today, the Federal Reserve's monetary policy is clearly stimulating the economy right now. The question is it a strong enough force to completely counterbalance the shock that we are seeing from energy? Well, in order to answer that question, we can look at our favorite indicator of the business cycle, and that is the yield curve. This is one of the most powerful macroeconomic indicators that exists, because when we overlay the unemployment rate, we see that it is a perfect match. The reason this works so well is because the yield curve is essentially a reflection of how the treasury bond market is pricing the strength of the US economy. When the yield curve does what's called a steepening, it tells us that bond investors are expecting economic weakness. This typically happens when the unemployment rate is rising and during economic recessions. When the yield curve is doing what's called a flattening, it tells us that the bond market is expecting the economy will strengthen, which is typically associated with a stronger job market. Now, what's fascinating is that if we zoom in on the 1990 recession and we overlay the price of oil, we see that the oil shock that took place in 1990 as a result of the invasion of Kuwait was accompanied by a large yield curve steepening. So in other words, following the oil shock, bond investors were pricing a higher likelihood that the economy would be weaker. The exact same thing happened, for example, in 2008, where the large move up in oil eventually caused the yield curve to steepen as the bond market was expecting the economy to weaken and accelerated the path towards the great financial crisis. If we look at the situation today, it is remarkably different. Yes, the yield curve had been steepening in the last couple of years as the unemployment rate was rising, but again, in the last couple of months, we've actually seen the yield curve flatten a little bit, and this is despite the large jump in the price of oil. So in other words, the bond market is not at all getting stressed out about the possibility of a recession taking place like it was in 1990 or in 2008. If we were really heading into a recession in the next few months, we would be seeing the yield curve steepen significantly just like it did in those instances. What we're seeing right now does not fit this, and indeed suggests that we're likely not heading into a recession in the next few months. Now, does that mean that we should expect no recession to take place for multiple years to come? Well, not so fast. The very fact that the economy is holding up and that the job market is strengthening despite higher oil prices could quickly turn into a problem because it significantly increases the risk of higher inflation. So for us, while the probability of a recession happening in the next few months has come down significantly, the probability of higher inflation, on the other hand, has gone up substantially. Because this is happening right at a moment where commodity prices are at a major pivot point. This is the growth rate of commodity prices going back over 100 years. They typically swing up and down in a very cyclical manner, and they're currently turning up from a decade-long downswing that has been fueled by high supply and low demand. The 2010s was a period where capital was allocated to software and apps as opposed to real tangible things. This also happened in the 1990s with capital being allocated to the internet. But we're now pivoting to a world where capital is beginning to chase real tangible raw materials. The world is deglobalizing, military conflicts are causing supply constraints, and abundant government spending is adding fuel to the fire. Just like it was in the 2000s and in the 1970s and in the 1940s, this upswing in commodity prices will be inflationary and we think has significant room to run still. For now, this is not a problem. But this could quickly turn into a problem as higher inflation will eventually force the Federal Reserve to raise their interest rate again. And that would be the nail in the coffin for the economy. We're not trying to be alarmist here. This is our sincere opinion, and we want to make sure that you're paying attention to the right data. Now, what does this actually mean in terms of how we allocate capital? For the S&P 500 over the next few months, the strength of the economy could continue to push it considerably higher. But if we're heading into a similar environment to the 2000s or the 1970s, the market could start to get a lot more choppy. That's where long-term investors should be ready to buy large dips. It is at these moments where you see the most incredible long-term investment opportunities pop up. Now, at Bravos Research, we're significantly increasing our exposure to investments that can outperform significantly in that type of economic environment. For instance, the Natural Resources Equity Index has already outperformed the S&P 500 by over 30% 10% in the last year. And this is just the beginning. We expect this index to continue outperforming the S&P 500 even as it is rising, but also continue to perform well when the S&P 500 is falling, which is pretty much exactly what we've seen take place over the last year. Now, we can use an index like this to gain exposure, but there are certain stocks within this index that are going to see considerably more upside if you know where to look. Take this stock, for example, that we call our Tier 1 uranium reserve play. This is a company that is expanding its profits right now at a historic rate. In the current uranium bull market that we're experiencing, it's already up 200% over the last year, tripling in price, significantly outperforming the natural resources index, let alone the S&P 500. And right now it's on the brink of another major breakout as we speak. This is not just one more leg higher. We think the real returns are about to be made on this stock. We have multiple other companies that we're looking at right now. Some are already part of our portfolio that we think are on the brink of major moves. Now, this is why we put together the special wartime invitation that allows you to try our service out at a fraction of the usual price so you can take advantage of these stocks before it's too late. This will only be available for another 24 hours because this is a steep discount compared to the price that we usually ask for. You can click on the link in the description below to see the invitation. I look forward to having you on board. Thank you for watching.